I'm delighted to be joined today by Charlie Morris from ByteTree. Hi, Charlie. Thanks for joining us.
Pleasure to be here. Thank you.
It's a pleasure to have you. So we're going to be talking a little bit today about Bitcoin and the correlations between interest rates and bond yields, for example. So Charlie, tell us a little bit about some of the research that you've been doing and what you've been noticing in the macro market overall.
Well, by trade, I'm a multi-asset fund manager, so I've been looking at cross correlations for 2 decades, as you can tell by the color of my hair. The relevance right now is it's the Jackson Hole shindig, where they all get together, all the global central bankers get together. This time, unfortunately, like us, it's not in person over a nice dinner. It's over a video call from far away.
Yeah.
But nonetheless, we're going to be talking about what's happening in the world. And in our first slide, we basically look at the combined central balance sheets. I'm sure many of you have seen this before. But I think what's interesting about it is that basically Bitcoin spent a lot of time going up and some time going down and some time consolidating. And the time it's been going down has been at the same time when global central balance sheets have also been contracting, namely 2014 and 2018. And, it's as clear as mustard.
Brilliant. Okay. So moving on, we were looking at Bitcoin responding to a falling in interest rates.
Yeah, so the second slide, we're actually looking at real interest rates. And a real interest rate is the difference between the bond yield, in this case, the 10-year, and the future expectation for inflation, known as the break-even rate. So it's not what inflation is reported over the last month. It's what the bond market thinks it's going to be over the next 10 years on average. Of course, it's wrong, but it's what it thinks it is going to be today.
Okay.
And so it's the best guide that we have. And basically gold trades off this quite heavily. So when real interest rates have been falling, gold has been going up quite aggressively, and vice versa. And so in 2013, real interest rates went up a lot when the Fed indicated they were going to start hiking rates. They didn't start for a while, but that's when they first talked about it. And that caused the price of gold to crash. Incidentally, Bitcoin actually did very well in 2013. So that was one of the times when you sort of said, well, this really isn't gold because they're behaving completely differently. One went through the roof and went through the floor in that same year. But over the last couple of years, you're starting to see the linkage increasing. And in this chart, I've actually inverted the axis. So what you're seeing is a rising real interest rates, actually a falling real interest rate. So you can see the line. But when real interest rates have been falling, Bitcoin kind of ended its bear market in late 2018. When they stopped falling, we had a period of consolidation in Bitcoin. And then when they started falling, and I reiterate, that means the line rising, then Bitcoin carried on its charge. And really in the last few months, particularly post-COVID, the link has been very, very strong indeed. And so, you could argue that Bitcoin's becoming a bit more gold-like. And I've been tracking this for several years now, and I can tell you that it hasn't been very gold-like at all. But recently there's some indication that it might be happening.
Indeed. Okay. So let's move on to Bitcoin as a risk-on asset.
Sure. So in this chart, and I'm going to look at your camera again in a second once I refresh myself. So there are a couple of periods here. So in white, we've got the periods when the bond yield has been rising. And then in red and green, we've got the periods when the bond yield has been rising. Mm-hmm. Now, approximately 95% of Bitcoin's long-term heroic rally has coincided with rising bond yields. Now, you might think that's bad. Everyone says easy money is a good thing, but a rising bond yield is something you would associate with a growing economy. So basically, when the economy is doing well and is accelerating, the bond yield goes up, and when it's crashing, everyone starts buying bonds, and so the bond yield goes down. So a rising bond yield, despite being a high discount rate on assets and so on, is actually showing that the economy is doing better. And the interesting thing here is a lot of people think that Bitcoin's a risk-off asset, i.e. you should buy it as a flight to quality. And I disagree with that. I would say it's very much a risk-on asset, as are many internet stocks, indeed. In fact, most of the stock market would behave in a similar way to that. And so, Bitcoin is a risky asset. It's a very good asset. It's going up a lot, which is good. But it tends to make most of its money when the economy is doing well. And that's certainly the observation from the macro. And the good news here is that obviously the long bond yield has been collapsing over the last couple of years, particularly this year. Which kind of explains why Bitcoin, it's done nicely this year, but it hasn't done nearly as well as it has in other years. Mm-hmm. And so I think if the bond yield starts recovering, which is likely to happen, particularly following what we're going to like to see over the Jackson Hole summit, is a rising bond yield, a recovering economy, and a higher Bitcoin.
Interesting. Okay, and does Bitcoin benefit from rising inflation?
What it does. I mean, that's the good news, and that's hardly a great surprise. I mean, there is a sort of inverse correlation to the dollar, but that's a small thing because effectively, that's just a measurement thing. I mean, the dollar doesn't move much, but if it goes down a few percent, you'd expect Bitcoin to rise by a bit more than that. But basically, when it comes to inflation, it's a very similar story to the bond yield, and the vast majority of Bitcoin's return has coincided with periods of rising inflation. And so when we look about, the last few years, 2018 in particular, we had the central bank's balance sheets easing. We've had bond yields coming down, inflation coming down. The negative real interest rate has been helpful, but actually more helpful would be, more bond yield, more inflation. That would really boost it. And so, I just come to the conclusion that the Bitcoin's inflation sensitive and it's a risk on asset. And that's a really important point for people to believe when, constructing portfolios. If you want something risk off inflationary, you want to own gold, risk off deflationary, you want to own the 30-year treasury. And that's how you build a portfolio around that. And when it comes to risk on, well, you've got lots of things to pick from, but make sure that you understand that Bitcoin is only risk off in some kind of hyperinflation environment. And I guess that's not going to happen this week.
Fantastic. Charlie, thank you so much for joining us today. It's been a pleasure.
My pleasure. Thank you very much.